It's one thing to listen to Tesla institutional analysts spout out their price targets, and it's a whole other matter to actually see the full analysis that went into that forecast. Today, we get the chance to speak to a Tesla retail analyst who will share his detailed report. AJ will walk us through in detail how he derived his Tesla price target of $600 by next year. His report fully models and breaks out Tesla's current and upcoming revenue streams. This is definitely a must-watch for all Tesla investors. AJ has a background in finance and physics. Before he became active on X, providing independent financial research, he retired from investment banking, where he advised public companies on mergers and acquisitions and other capital markets transactions. AJ will be speaking to us off camera since he prefers to stay anonymous. Welcome, AJ. Thank you so much for doing this.
Hi, Herbert. Thank you very much for having me.
So I've been following you. You've risen quite quickly in the X community, Tesla retail community, because you come with a lot of analysis, spreadsheets, calculations, forecasts, those kind of things. But you back it up and you show the work. I saw recently your most recent detailed analysis. By the way, folks, if you want to, you can follow AJ on X at ALOJOH, and he shares this information first to his subscribers, and then he released it, and that's when I saw it, wanted to bring on board right now. So he's predicting $600 by end of next year. He's going to walk us through his detailed report. Go ahead, AJ. Thank you.
Thank you very much, Herbert, for introduction. So there's a lot of stuff to cover, but I also want to make sure we can reach as many people as possible. So I need to cover a few fundamental valuation points. Basically, all investors globally, they always look at PE ratios. PE ratios put the share price and earnings of a company in a ratio to see how high or how low its value. Is it too pricey? Is it cheap? This is basically the idea of it, and that's why when you look at a company, you should always try to work out what's the PE ratio, so you have a sense how expensive is it if you buy a stock in that company, because the PE ratio tells you how many dollars you have to pay today for the next 12 months of earnings of that company. Of course, you can define the PE ratio differently, but the default in the global financial markets is, if people don't tell you what PE ratio they're talking about, it's always the next 12 months. It's always forward-looking. It's never trailing last 12 months or what have it. It's always the next 12 months. So this is a key thing to keep in mind. A quick way to abbreviate it in the jargon of Houston Finance is NTM. NTM stands for next 12 months. If the company like Tesla reports quarterly, it's the next 4 unreported quarters. And here on the first slide, here's a lot of stuff, but just really quick. On the right-hand side, I just show the fundamental math. So if the share price divided by the EPS gives you the true PE. And the reason why I call it a true PE, I look back at a company's history and I look at, okay, on a given trading day, given share price. So here in this chart, the blue line is the share price and the red line is the implied PE. What I do is I go back and from a given day's perspective, what were the actually delivered next 4 quarters earnings of Tesla? What did the company actually deliver? And this number is basically equivalent to a consensus that would be 100% accurate. And then, but the problem is you always have to have 4 future quarters to work out the PE. So of course, at the current share price, we have to add estimated quarters. So when you look at this red line, this is all historic data, all delivered by Tesla. And then, of course, as we run out of next 4 quarters, the PE adds my estimates. And over time, as we go into this area, this blue line, it's entirely my estimate. So keep this in mind. The transition from actually real observable Tesla PE into my forecast. And so next, let's just take a quick look at the multiple. It's very important. This is a fundamental thing any Tesla investor has to understand. Tesla has been trading at a very high PE ratio for a very long time. And that's why applying like something silly like PE ratio of other auto companies makes completely no sense, because Tesla has defended this multiple for a long time. As you can see, for example, in the 2019 era, the red line here is in a below 40 range, as you can see. I know it's very hard on the screen. I tried to zoom in a bit, but then it skyrocketed, and then and this was in the 2000s, early 2021, and this was driven by great performance improvements, great earnings growth, but also there was a lot of expectations about FSD, etc., and S&P inclusion, short squeeze. A lot of stuff came together. I'm not even scratching the surface of what happened there really, and you see it rose quite dramatically, and the true PE of Tesla actually and ended up being almost 180 times, which is extremely high. And this in a few months before Tesla jumped this high, Elon even posted, we have to execute perfectly, otherwise the stock deflates like a souffle. People in the know will still remember this comment by Tesla. But long story short, then the stock kind of came down for a bunch of reasons: Twitter, inflation, rising interest rates, yada yada yada. Then when the stock crashed down to around $100, the PE ratio also dropped a lot. And if you would have followed this analysis, you could have seen that the stock moved way below the typical high PE range. That was a phenomenal buying opportunity. But anyways, so what I did in this analysis, I looked at the last 12 months, because you want to have a recency bias. You don't want to look at super old multiples. For example, these EV high PEs from the 2000 are not relevant in 2024, 2025. So you want to look at the more recent time frame. This is why I'm taking the last 12 months median multiple, which is, as of the date of this analysis, which is about 2 weeks old by now, it was 74 times. So of course, if the multiple goes up, my valuation or my price target would go up. If the multiple comes down, my price target would come down, obviously, even if earnings don't change a bit. So, but keep in mind, we're walking into 2025, and there will be for the first time ever, a friendly government to Tesla. So I don't expect Elon being this close to POTUS that the PE comes down. I think that's an absurd assumption. So I think it's highly rational to assume that the median PE that we sustained even through a highly hostile government should be maintained. So I think the multiple is actually conservative. So this is one big piece of the puzzle. So now we go to the next one. The next puzzle we need to work out the implied price target is of course the earnings. And these numbers that you see flipped here by 90 degrees, these are my next 12 months at that point in time EPS estimates, and you see they go up. So when you look at this number, and we come back to this number much later, this 9.64 numbers, and this at this point in time, so this is like late 2025, early Jan. This is the next 12 months earning at that point in time. This is not from today. This is critically important. When we talk about price targets, if nobody tells you what price target they always mean 12 months out. It's the default in the global financial industry. And my price target is for end of next year. But end of next year, the relevant earnings number is at that point in time, the next 12 months. So that's basically 2026 earnings. This is critically important to understand, because I often get the comments, oh, do you really expect like $9 earnings in 2025? No, of course not. But this is completely missing how valuation works. It's always forward looking. This is something very fundamental. Every analyst learns this. And so anyway, so with these fundamentals out of the way, so you have the multiple 74 times $9.64 per share, you get to the 713. Very simple. So the rest of this video we basically spend on how we actually get to the $9.64. This is what we going to talk about. So I zoom in here. So and there's a lot to cover. And
yeah, a quick comment there. I think that you're right. $74 PE is 74 PE. I'm sorry, is actually very conservative. Totally agree with you. If anything, like you said, that's what it's been all this time. But if anything, that could grow, because we got the bot. We got, like, not only are these ideas anymore, these are almost like they're becoming reality every day as we move forward. So that's fair. Okay.
If I just take a little bit the other side on this comment, the fact that we have been trading at this high multiple for so long, just to give you a reference point, NVIDIA trades roughly around 30, 34 right now. So
right.
call it a little less than half, and it's a phenomenal company. This tells you that some of what you just said is already baked into the stock. So let's be fair. Otherwise, it gets a little too wild. But again, if you look at the red line, you can see there have been relatively long periods, and I'm not even looking at the bubble period of the EV bubble, where Rivian traded over 100 billion, which was ridiculous. There were many periods where you can see the multiple sustained for many months around 100. So what you just said can totally happen, but I just want to be slightly conservative. It's always good to not be, because this is wild enough anyway, because if this forecast is correct, we see 70% upside in the next 12 months, which is wild. And so with that out of the way, I jump to the next slide, which is just, it's on this slide, there's something funny. When you look at the X bar, you see, oh, there are no quarters anymore. It's months. So these months tell you when actually Tesla reports. So Tesla reports, for example, 4Q earnings in January. And at that point in time, the next 12 months, that's why it's called the next 12 months NTM chart. This $4.53 is at that point in time, the next 12 months. And then the next chart shows you how you get to this number. These are now we're going back to quarterly numbers. Quarter is more easily understood. It's in line with Tesla's reporting. For example, last quarter, Tesla reported 72 cents in EPS. And then you see my EPS forecast. But keep in mind, to work out the multiple, you need to add up the next 4 quarters, the sum. And you see this down here. Here you see the 9.64 we talked earlier about. This is the next 12 months at the end of 2025. So, and now we go to, okay, get to where, okay, how do we actually get to these earnings numbers? And now we start like really high level, and we talk about the big picture revenue outlook for Tesla. And Tesla, obviously, people who study Tesla for a long time, they know that Tesla has basically 3 big legs to stand on. One, Tesla is a leader in electric vehicles, and I will not go through all the advantages of electric vehicles and why it's completely obvious that they will replace ICE vehicles and slightly later also the hybrid vehicles. And this is a very large market, and Tesla is exceptionally well placed. Secondly, Tesla is a leader in commercial battery storage. This is an extremely lucrative, extremely fast growing market, because customers of such products, they can literally print money right now in various countries. And that's why they're trying to get as much product as they can bring online. But there's huge demand. And then the last one, and that's the big one, is really Tesla's AI leg, or as Tesla really becoming increasingly AI company. And we'll be talking about timing of these things, and AI products obviously comprise FSD, but also then later the Optimus the program. And I'd like to point out, these are just the things that we know today. A bunch of these things 5 years ago were completely unknown, and it's highly likely that Elon will come up with more stuff, which will ultimately end up on this page when I update this in a few years. So now, if we just look at these numbers, so the numbers in red are actually reported numbers. And as you can see, Tesla, and here you see the annual numbers. For example, in 2020, Tesla generated 32 billion in revenue, grew 71% the year thereafter to 54 billion, and so on. And then with kind of let's call it a pause year, and like starting in 2023, growth significantly slowed, and then 2024 is most likely modest 3% growth. And if you follow me on X at all, I explain in excruciating detail why this happened, and we don't have enough time to cover all of this in detail right now because we need to move on. But there are good reasons, and in the following you will see why 2025 will see reacceleration in revenue growth. And by the way, this 25% growth that I'm showing here for 2025, 125 billion looks like round numbers, but no, and it's like pull out of thin air. No, this is fully bottom up. It just happens to be kind of round numbers. So don't get confused by that. And then so 25% revenue growth is nothing. This is like significant, and we will see why in a second. And then of course 2026 it reaccelerates further. There will be another year-on-year 45% increase, which is quite wild, which would basically mean between 2023 and 2026 Tesla doubles revenue, and at 181 billion Tesla then really plays amongst the Magnificent Seven, even in terms of revenue size. So now so for example, to navigate all these charts and numbers, keep this 55 billion number here in mind. So you see how all these slides link together. So this 55 billion in 4Q 2026 is here on the next slide, this number up here. This slide is the exact same slide as before, but now it breaks everything down into the subcomponents. And the 13 revenue lines that I see in Tesla basically comprise the vehicle lines 3 and Y, S and X, Cybertruck. The next gen is what I call the upcoming models in H1 2025. This is only a few months away. Keep this in mind. The semi credits refers to regulatory credits. We can have a debate about whether they go away under Trump or not. For now, I have included them, and we touch on these later. There is auto leasing. I break this out separately because auto leasing has different economics from outright vehicle sales for various reasons. Then there is E&S. E&S is energy and storage, which will be the story in 2025. And we dive into it later. Why? Financially, this will make the biggest delta. And then we have robotics. Robotics will be a 2026 story. And then we have FSD subs. This is FSD subscriptions. This refers to the $99 people can subscribe to it for FSD. And then we have RH, stands for ride-hailing customers. This is a shorthand for the current Tesla. So Tesla owners can attribute in the future their vehicle to a Tesla ride-hailing network. Tesla told us they plan to launch a pilot in Texas and in California in the first half of next year. So it's also not far away. And if you look at the latest FSD video, you can see they have basically all the components in place. We have already seen prototypes of the app, etc. So this is upon us. And then RH Tesla is basically a cybercab. It's ride-hailing Tesla owned, because the ride-hailing customer owned Tesla only takes a revenue cut. It just manages the fleet, but a significant share of the revenue obviously has to go to the customer. Otherwise, it makes no sense for them to contribute their vehicle to the fleet.
I want to ask you a question on this. So first of all, thank you for putting out the 13. That's as detailed as I've ever seen it. It's interesting that by the end of 2026, you have robotics at 2.6 billion, but then you have ride hailing at 1.2, and then you add the subs 2.9. But still, that's a lot lower than, you've got robotics a lot higher at that point, which I actually agree with you, but it's that's very curious that you did that.
Very good questions. And we cover this all in detail later. And I think when you see the underlying detail, I guess it will make sense.
We'll see what your assumptions are at that time. Okay, cool.
Everything's like totally bottom up. I factor in ramp curves, initial lower profitability because of all this stuff. And I try to make, at least in my mind, as realistic a scenario as I can. But there's also something important I want to point out is when I model the things, I try to be as close to management guidance as I can.
Yeah.
I only inject myself if there's not, excuse me, not enough public guidance. But otherwise, I don't suppose I'm smarter than the Tesla people. Not for a second, especially not Elon. So I basically try to model out what their words mean in financial terms.
Nice.
That's
Yep.
basically my principle. And so basically, but we get to this later. And then the last bucket I didn't mention, which I think is the most underrated bucket, by the way, is S&O. So the S&O is service and other. And service, of course, is servicing the vehicles, but it also includes a bunch of other stuff like insurance, collision repair, the paid supercharging sessions, and various other things. And this is a very interesting segment. This is the only segment which has never seen a sequential revenue decline. It has always only ever grown. And this will not be a huge earnings driver, but it's a very consistent revenue driver, and over time also adds, because the big message here is, because you see these earnings numbers that I showed you earlier, and you think, oh, this is crazy, can't grow this fast. But when you break it down, you have to understand Tesla is a very complex business. They have all kinds of revenues line, and everything adds something. And when you add everything up, all of a sudden, holy moly, this is actually quite a lot of earnings generation. This is basically the story of this analysis. And that's why I'm so bullish about Tesla. So basically, if we now we are, I think, 22 minutes in. So we have to kind of rush through everything a bit, but I still try to cover the most important things. If we now go into the detail, we start with the first bucket. But by the way, these numbers up here, these are navigators. So section 2 means we are talking about revenue. And we stay in section 2 until we leave the revenue discussion. 1 refers to the bucket I showed you, the buckets I showed you before, the 13 buckets. It's the blue number, and then this lighter color is basically what part of that subsection we are in.
Understood.
So okay, so it's just a system for the next couple of slides. So the big revenue line will remain. The 3 and Y line, you see these bars going up, then they drop, then go up, etc. I try to reflect the global vehicle sales seasonality. This is mostly driven by winter, because a lot of auto markets, vehicle sales collapse during winter because people are just not very keen on buying cars in the wintertime. This is a very well-studied phenomenon. And on top of that, seasonality has been increasing because the importance, the weight of the Chinese market keeps increasing. And China has a very massive seasonality in 1Q because they have the Lunar New Year holiday, which creates consistently every year a significant, roughly 2-week drop in vehicle sales. And this also then has on global vehicle sales, like a dampening effect. So I try to model this. I can't go into every detail, we don't have enough time. But long story short, I think I've talked about this. Model Y refresh is upon us. It's extremely successful vehicle. It still sells extremely well, even in China, where customers are used to very quick refresh cycles. And so I'm very bullish on the success of that vehicle. Plus, I think there will be at some point an effect that FSD will have on vehicle sales. Some people will start buying Teslas simply because they can't get FSD anywhere else. I have already talked to people where this was the case. They weren't keen buying Tesla for whatever reason, but the FSD basically pulled them into the camp. There will be more of this. On top of that, low interest rates are really, really important in the car market. It's also well studied. Rates are going down. If Elon's Doge can really cut government spending, lower government spending is highly deflationary. Oil price still relatively low, especially if you do it inflation adjusted. Look at it, inflation adjusted, etc. There's a lot of good stuff. So there's a lot of stuff to be bullish about. Current US sales coming in relatively strong. So I could go on about this, but anyways, 2025 looks really good for the Model 3 and Y line. Here is just some details. So section B of the Model 3 and Y line, you can see my ASP assumption, and also my so here I just in the purple box I repeat the revenue line which you saw before. This greenish box shows you my average selling price assumption, and then I show you here how many vehicle sales I assume, and you see this isn't, I'm not assuming crazy growth. I am assuming 6% growth next year, and given that the Model Y is kind of stale by now, if we get the refresh, I think it's probably conservative, and it probably keeps growing into 2026. Then slide C in this section shows you then the details about the gross margin. The gross margin is going up because I believe more and more people will actually buy the software package. Penetration of buyers that actually buy FSD was low, but Elon also told us on the 3Q call that after the 1010 event, Cybercab event, take rate has significantly picked up, and this rate will only further increase as FSD improves, and this makes a significant impact on the average selling price, because when Tesla sells a vehicle where people buy FSD, it creates a higher revenue number, and this is reflected in these numbers. This is also bottom-up model. I assume over time a phase-in of FSD. You find details on the slide, but let's move on. And next one is a Model S and X. You see, I have very little compared to historical sales. I have very little momentum modeled from S and X, and the reason is I think Cybertruck has a significant cannibalizing effect on S and X. I know a bunch of people. Yeah, so we don't need to spend time on this, but also I think there's a little bit of uplift. It will not be a needle mover because also driven by FSD, and I think as Cybertruck's novelty effect wears off, some people who are really not truck people, they will say, okay, S is actually quite a nice vehicle, or X, because not everyone is even though Cybertruck is a phenomenal vehicle, of course, but some people, I think because it's huge, hard to park, some people might go back. But anyways, so again, this is not a big needle mover, but it adds in a small way. Then we details about S and X in the same way as for Y and 3. You can, I think, look at it in your own time. Herbert will share all these slides in detail, so we can go through the more interesting pieces. We move on to Cybertruck. Cybertruck is a needle mover since it still keeps ramping. There was just the other day news about Tesla shutting down the Cybertruck line.
3 days.
Yeah, for 3 days exactly, and I don't think there's a demand problem. I suspect the line was basically, as far as I know, almost without any interruption operational for slightly over a year by now, and it's completely normal to do some routine maintenance, etc., upgrades, and for some stuff you have to shut down the line. It might also be related to preparations for the lower cost trim, and I totally expect the lower cost trim to hit the market in probably just a few months. And then, so this will of course drive demand, because a lot of people, they simply can't afford an $80,000 truck, but 60 opens up a much larger market. Plus, Tesla has not yet started meaningful international deliveries. There have been relatively small numbers to Canada, but really there are also other potential markets where Tesla could ship the vehicle to, and given Tesla's existing global network of showrooms, it's literally just shipping the cars out and adding them to showrooms, as long, of course, they meet the local licensing requirements of that type of vehicle. But given that even in Europe, I see some F-150s occasionally, or some Rams, and we know the Cybertruck has like similar dimensions. There's probably a clever way to make it work even in Europe, and there are some Asian markets where we know where you can license it. Just a long story short, there's a lot of market potential. Even if Cybertruck turns out to slightly weaken after 2026, it doesn't affect this forecast. So keep that in mind, because after 2026, we're not going to talk about cars anymore anyway. So yeah, I know it's an important point, because people think like, oh, what if a better, if there's market share losses, blah, 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 all this
Who
BS.
cares
I'm
at
sorry.
that point?
Who cares? It's like talking about iPod sales in the year 2013.
Nice.
It is, and so this is something keep in mind. Don't be bean counter, what I'm trying to say.
Yeah.
And so basically, I also covered the detailed assumption of Cybertruck, average selling price, and number of vehicles, and also my gross margin assumptions. We learned from CFO that in 3Q, Cybertruck was actually gross margin positive, which is very impressive, given the way Cybertruck is made and the volume, the line capacity, and all these things. Just real quick, if you build a line for very high volume, it's usually very costly, because you need a lot of machinery, tooling, blah, 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 blah. So you have a lot of depreciation charge, because the depreciation charge in Tesla's case is almost exclusively for the useful life of the tooling, etc. Hence, the volume doesn't matter. So the depreciation charge is every quarter the same, no matter how much you make. So if you have low volume quarters, like we're still in the ramping phase, you have a massive depreciation charge hit, and that's why Tesla hitting a gross margin profitability
is such a big deal,
while they're only selling roughly 16,000 units, is actually very, very good, and that's why we can look forward to some nice gross profit contribution from Cybertruck soon. So anyways, so then we move on to the next gen vehicle. This is the revenue forecast, and you see I expect a little bit of revenue from 3Q 2025. So just want to point this out, there's no crazy number here in the forecast from this vehicle in 2025. And then in terms of the detailed assumptions, I think this will be not a super cheap vehicle. Elon made a comment in this regard. So this will be slightly below Model 3, and I think the next Model Y will be move slightly up in price. This is a very common, if you have, very quickly in the auto industry, it's a very successful strategy. If you have a killer product like the Golf, the Corolla, the BMW 3 Series, E-Class, like I'm talking from 20 years ago, you want to slightly upgrade them every time. So they move up over time in vehicle class. For example, the 3 Series later became the 4 Series, but it used to be more like entry-level BMW, relatively affordable. It became relatively expensive, and this strategy made a lot of sense. And I think Tesla will do something very similar. They will slightly upgrade it, but also make it a little bit more expensive, and so this also creates more pricing niche for this vehicle. Anyways, this whole pricing thing would be a 2-hour debate in by itself. So we move on, and the next piece is then again here gross margin assumption for this vehicle, and then we move on to the Semi. The Semi is really kind of irrelevant for 2025 because the factory isn't done. Factory is supposed to launch from early 2026. You see here my revenue assumption, which is derived from these volume assumptions. So I think by the end of 2026 they could make 9,000 vehicles, because this is the first time they're making a very large vehicle. It's like a bit of a different process from vehicle, like car manufacturing. So I try to be conservative. Tesla, so I forecast for 2026 15.6K vehicles, and then when you annualize the last quarter, the 9K, you get to like 36K run rate at this point, which is roughly in line with what Tesla guided for what they aimed for annual Semi sales, if I'm not mistaken. I think Tesla said something around 35 to 50,000. But this is maybe slightly
50,000 for the factory.
For
Maximum
for
capacity. Yep.
Yeah, for that factory. So this is maybe slightly conservative, but with the things that are so far out, you want to be a slightly conservative, I think.
Yeah.
And then so bottom line is based semi is not the needle mover for 2025 really. So then here again, the details of the semi, my production cost assumption. Right now, I think it's highly loss-making simply because the semis are right now basically made by hand. This is always very expensive, very low volume. It's just for pilot customers. But again, it's not a massive cost, so nobody really has to care about that. But it's also included in my forecast. Then we get to auto. So then we get to credit sales. That's the piece that for a few weeks ago caused some share price pressure. People were talking about Trump removing all these subsidies. I mean, and let's call it what it is. It is a subsidy, but you also have to keep in mind the other side, which is ICE vehicles, is also highly subsidized in various ways. So if you argue, oh, Tesla is going to lose the credit, well, you're really not fully covering the argument, because if you argue that it will go away because Trump cuts the subsidies, so why do you think he will only cover that subsidy? Isn't it reasonable to assume that maybe the other ICE subsidies will also be touched, which would basically level the playing field? And actually, more strategically, Tesla is the only one who can currently sell EVs in the US without the credit sale profitably. And we know this for a fact. General Motors was quite clear in their investor presentations about it. They highlighted this item as a very big profit driver. And when you read the transcript, you can see the same. And basically, GM is basically effed if they can't get the credit, and especially if the IRA also goes away. There's another thing, the US battery makers, which also includes GM, they get a massive subsidy for every kilowatt hour they put in the car. This is on top of this credit sale. And this one, if that goes away, then basically GM can stop the EV production, and they will, by the way. If they lose the IRA and if they lose the credit sale, GM will pull out of EVs. You can mark my words. So that's why I don't think Trump will do it, because then he becomes basically enemy number one by the unions, and I'm not sure if he wants to do that politically, because he has bigger fish to fry, frankly. And so that's why I consider this item still fully in my forecast. But of course, there's a risk factor, because this item is, you see here, this revenue, and when you look at these numbers, they look quite small, but you have to keep in mind this is pure revenue. So it has a meaningful impact on the bottom line if it goes out. But for me, I don't really care, but because I look further out, and this is not really the story, because there's still enough upside even if it goes out. So I'm not worried about this. I just want to cover it, and again, it fully flows through my forecast. And if you're the opinion it goes out, just take these profit numbers that you see, these revenue numbers, off my EPS, my earnings, and then you have your adjusted number. Easy. Then we move on to leasing. Leasing will increase a lot. So you can see how the leasing revenue has come down. This was driven by Tesla totally de-emphasizing leasing, not really offering attractive leasing deals. This was the perfect call, because leasing becomes very expensive for the automaker when resale values drop. Tesla knew that cars they were selling were at peak prices and they would come down. So any vehicle they would lease, it comes back. They have an issue with the resale. BMW completely dropped the ball on this one, had a massive negative free cash flow in 1Q this year, and later more cash flow pressure because of this stuff. And so this shows me that Tesla is really well run, even just as a car company, and these people really know how to run an auto company, and better than some legacy makers. This is very impressive. But recently, Tesla changed course, and I think it's the right timing because resale values have stabilized. We are probably at the bottom, and now they have gone out with aggressive leasing deals, and I also try to reflect this here in my forecast, where I basically expect a growing leasing penetration going forward. This is also partially driven by lower rates, of course, which make the leasing deals more doable for automaker. I won't go into the accounting of leasing deals. Bottom line is it makes the automakers financially look worse, and it exposes the automaker to balance sheet risk unless they package the leasing in some securities. But this again would be an hour in itself, so I won't cover it today. Then we move on to the story of 2025. This is energy and storage, and it should really be called. It shouldn't be called energy generation and storage. It should be called energy storage and a little bit of generation.
Yeah, it's not generation. Yeah.
Yeah, and because this is basically all about megapacks, but also the consumer product Powerwalls is also doing quite well. It's just in the shadow of the massive megapack sales, but on its own, this would also be an attractive line because it likely has significantly higher gross margins. And we get into this in a moment because it's a very important point. And we know Tesla is about to bring online their Shanghai Megapack factory. From satellite pictures, we know it's probably around 3 times the size of the current Lathrop one. It's purpose built for making megapacks. The Lathrop one, the old one, was basically I think it was a mall or something. But the long story short, output of that factory will be massive. Tesla has the benefit of accessing directly the cheap Chinese supply chain, makes it much more competitive. Yada yada yada. Very good things to come. It will grow very quickly, and when we go into the details. This is in terms of kilowatts, what I assume. If you remember in 2Q this year, Tesla blew everyone away when they reported 9.4 gigawatt of install, which was like the highlight, and this then starts sort of the real first rally of 2024. Then it came down, but Tesla told us it would come down. You just need to listen to the CFO. He told us this is volatile. When he says something is volatile, he means it will come down. And there are various reasons, good reasons why this happens. You have to keep in mind the moment a megapack leaves Lathrop right now, it can sometimes take 6 months till you see the revenue of that megapack reflected in Tesla's accounts for logistical reasons, for permitting reasons, licensing reasons, yada yada yada. So so if you want to learn more about this stuff, I recommend you read a book about project accounting. But again, this is something we can cover here in detail due to time. And you see from 2025, I expect significant growth. And if you listen carefully to what Tesla told us on calls, etc., they are also very bullish on this. So I feel very good about this forecast. And then when we look about, okay, what are the pricing assumptions? So I'm assuming actually significant reduction in average kilowatt prices. For example, in 3Q, we were at a very high 317, which was actually part of the reason why my EPS missed. I thought it would come down, and somehow it increased. And the CFO told us an interesting little tidbit. He didn't go into detail, obviously, but he said it had to do with the combination of projects in that quarter. I think it was kind of one-off. There were probably certain projects, but anyways, let's not get in too much into the weeds here. But I think it will come down, and if you do research on this topic, you see that the Chinese are aggressively pushing onto the market, and the Chinese the latest research I've seen, some Chinese companies currently offer below $100. So, but the reason why I'm still showing these what looks like high numbers, first of all, Tesla is not only selling in China, they're selling also in the US, and Chinese companies have trouble selling their products loaded with Chinese chips in the US market for obvious reasons. and some companies simply won't touch them. And so I think there's still plenty of market for Tesla to service. On top of that, Tesla has software advantage, and Tesla has talked about it. Tesla had cases where customers of Chinese companies switched because they had issues with the Chinese supplier. So that's why I think prices will not collapse, but they will come down partially as a function of Shanghai coming online. So anyways, so if we move on, so here's the gross margin, because I expect Shanghai also have significantly lower production, because I expect actually gross margin to come down slightly, but then will remain strong for some time. And this is also a function of the things I said before. So this is I expect this to be the highlight of 2025. Because we'll have a significant gross profit impact. And this is ultimately what matters. And then we go to revenue stream number 9, which is in robotics, which is basically at the moment Optimus. I call it robotics because Optimus will not be the only product they will make. There will be other bots. That's crystal clear. You see in my forecast there's very little Optimus revenue. 6 billion for the full year. It's ramping quickly, but not that much really, because Tesla at this point is already significantly above 100 billion in revenue. And then obviously early on, and sorry, I jumped it too quickly. And obviously early on, there will also be some inefficiencies in production and cost. It will not be a huge gross profit driver. So again,
but you're assuming that there's actual revenue, because they already said that there'll be 2,000 in 2025, but they will not sell it to anybody else. In 2026, that's when you start adding revenue. But 2.6 billion by fourth quarter. It's a lot.
Yeah, because okay, the thinking behind this is the following. So 2025, as you say, internal testing, pilot, or also they might give some of them to customers, to suppliers correctly, to do pilot program, just as they did with Pepsi and Semi. It makes complete sense and totally expected. And then they work out the kinks, and then they will find use cases where it makes sense, and then they slowly start. But given it's Optimus is really a software problem that there will be, and given how much compute Tesla has now, and it will ramp throughout 2025. I think once it gets going, it can grow very quickly, because ultimately it's only 130 pound product. And it's not a 2-ton Model Y product, and you can simply ramp these things much faster. If you look at comparable products, and like if you again, we don't have the time to go into detail, but the bottom line is if you have an object with that mass, this size, you can ramp it easily 10x faster than vehicle production.
For sure. When it comes down just looking at your numbers, though, I see that which is it? Is it 11,000? Is it 99,000 robots?
I didn't. Sorry, I should have shown. No, I didn't include that slide. It's, to be honest, I can't tell you off the top of my head the number of units right now. I mean, I give you. Yeah,
I was just reading on the side there your forecast, and I'm trying to guess how. Yeah. Okay. I mean, it's a big topic because this is it. This is the bot. This is the thing that's going to 2.6 billion in one quarter. That's a lot of money.
Yeah, I give some indication, but and next time I should also show you the detail. But anyway, once this takes off, it can get quite crazy quite quickly. And then I also expect that there will be some multiple bump, to be honest, because then we get into robot Uber hype. I mean, for good reasons, to be honest. And this is wild, but I really see it as more of a 26 story. And then we go into FSD subscriptions. These numbers also look quite small, but keep in mind this is all software revenue. There's basically zero cost against this, because all the FSD or most of the cost is reflected. A lot of it sits really in R&D. And because the Colossus compute, I mean, CapEx, so most of the cost is CapEx. It's being depreciated over time. But long story short, every subscription is basically almost pure profit to Tesla. So this is also meaningful in terms of earning generation, but not so much in revenue. And again, so right now there's relatively little. This is all bottom up from North America FSD fleet, $99 a month. Also some assumption for international. It's not a big needle move, and that's why Tesla hasn't broken it out, nor has the CFO talked about it, because right now there's just not much, just not a big needle mover yet, but it will grow. And then we talk about the ride-hailing revenue from vehicles that Tesla customers own. And here we talked about it initially. Tesla wants to do a pilot early next year in California, Texas. I basically factor in no revenue from that pilot. They will work out the kinks. Elon told us by middle of next year, that's their internal timeline basically for FSD readiness, if you remember that comment. And that's why I factor in revenues coming in from 3Q. But of course, you have to factor in not every Tesla owner will jump on that opportunity, wants to have its car drive off and potentially come back with some vomit in it. There will be some hesitation. Some people just don't need the money, and so there will be a ramp up in participation rate and word of mouth and all these things. So that's why I'm also not expecting massive revenue in 2025, 2026, as you can see, but it's scaling. Then we talk about the Cybercab. Cybercab, we know Tesla wants to launch middle of 2026. So that's why there is no revenue in my forecast on Cybercab. All the upside from FSD improvements is really baked into the average selling price assumption as people buy more software packages, as I mentioned earlier. And then we come to the final revenue stream, which is Tesla's service and other. And you can see I included here only 7 months of historical quarterly performance, and you can see it has always grown. And this trend only going to continue because simply the Tesla fleet just keeps growing very quickly. Tesla adds right now on a 12 months last 12 months sales rate around 1.8 million vehicle every year, and next year is going to be a lot more probably. So the Tesla fleet will probably cross the 10 million line somewhere in 2010, and that and the important thing to remember is because Tesla grew so quickly in the last few years, a lot of the big selling quarters are still warranted. But some of these big selling quarters are soon dropping out of the warranty because of mileage or because of age. And this will then fuel more service revenue, etc. And the cool thing about Tesla, which is different from every other automaker, is that Tesla captures 100% of the service revenue. If I go to BMW dealership and have something fixed, BMW only makes money on the OEM parts. They charge a huge margin, send it to a dealership, but the dealership fetches all the margin on the labor and all these things. Tesla takes all of that. And that's why this is more interesting segment in Tesla than it is for other automakers. And then basically we go to basically what this all amounts to. So this is gross profit. And on this page, there's absolutely zero assumption. This page, and now I zoom over here, and that's why I have this stuff here. Gross profit is simply the sum of all the revenue less all the cost of that revenue. This is gross profit. Simple. And this is just a mathematical outcome. Here are no assumptions. If you believe in the things that we just walked through, this is just what you end up with. And what you end up with is quite interesting. So in 2024, we come in probably at 19 billion gross profit. And then next year, we are basically bound to grow 42% to 27 billion. And then we grow 82% the next year. Because a lot of these seemingly small things, they stack up and they all add a little bit to gross profit, and this just supercharges then your gross profit. So now we go to keep this in mind. Now we need to look at the accounting a bit. So gross profit we just discussed, and now we need to talk about all the operating expenses. And one big operating expense, of course, research and development, and this was actually the primary reason for my EPS miss in 3Q. Tesla somehow managed to significantly reduce R&D expense, even though they're making freaking Cybercab, they're making the new lower cost vehicles. I'm sure they're launching Juniper. I don't know.
And the data centers.
Data center, it's crazy. I don't know. This was the main reason why I missed. Go back, look it up. It's true.
Yeah.
And so but I'm conservatively, maybe wrongly, assuming it will grow. And you can see this here. I'm actually even assuming double-digit growth.
You should definitely increase R&D for sure. Despite that they shocked you last year.
Yeah. The Tesla, Elon basically tells you everything you need to know. He basically tells you, we want excellent engineers, but excellent engineers are extremely rare by definition almost. And I think they're maybe limited on that part to get the right people and also with the right culture, because you don't want woke people in your team. They screw you.
Well, wait, when you spend money on on the NVIDIA chips and all that, where does that go? Is that R&D or is that in assets?
It's not R&D. So all the hardware.
Yeah.
All the hardware goes into CapEx. You see in the cash flow statement, and then the only thing you see in the P&L is depreciation of that CapEx.
Gotcha.
So anyway, so this is research and development. Then we talk about selling, general and administrative expenses, the other big one, and here important to remember. CFO talked about this. The 2Q headcount reduction led to a 1 billion annual run rate savings rate of expenses. So that's why Tesla's SG&A expense went down so much in 3Q. As you can see, we see the effects of this. So my 4Q assumption might be too pessimistic, really. And by the way, the reason why it fluctuates, this also reflects the global auto seasonality.
All right.
Because some of the SG&A expense has to do with vehicle volume. And that's why you see this. This is also reflected here. And then you basically get to we talked about SG&A. Then you see so this is an interesting metric because it shows you what do SG&A expenses, how do they develop relative to revenue, and you see the ratio, how much of your revenue you spend on SG&A goes down a lot. But as we just said, I expect SG&A to go up actually faster than it did historically. And the reason the ratio goes down so quickly is because the revenue line grows so quickly. And a big driver is there is more and more software revenue coming into Tesla. And software revenue has basically close to no SG&A against it. And this is why this is often called an efficiency ratio. It's going down so quickly, and the smaller it is, the better. And there are some car companies that have. I mean, Tesla is already very strong, but because of some are much. Anyway, long story short, I feel very comfortable about this forecast, and this is also a big driver. It's basically this slide talks about fixed cost absorption, and there's a lot of it in 2025, which is also a driver of earnings. And then we go to operating margin. This slide there's also zero assumption here. This is all just a mathematical result of the things we discussed. And over here, I just lay out how you calculate it. You just take operating profit and divide it by total revenue. And you can see it's growing quite quickly. But again, this is not pulled out of thin air, because I see some people that just make up some operating margin and then drive their EPS with it. It's crazy. It's not how you do things. And but this operating margin is basically the result of all the assumptions we talked about before. It's just a mathematical result, just as gross profit was before. And then we look at what this means actually in dollar terms. And this is where it becomes really, really interesting. So this is operating profit, and you see it kind of takes off. It becomes quite wild. And again, this operating profit is not forecast, it's an output. It's an output of everything we discussed. And I want to quickly review how you calculate it. You just take the total revenue, take off total cost of revenue. It gets you gross profit. From the gross profit, you take off all the operating expenses that we covered. And the most important ones is research and development and SG&A expenses. Restructuring charges are non-recurring. They happen if Tesla decides to cut people, but they happen very infrequently, so it's really a one-off thing. So the bottom line is you take gross profit, you take off all the operating expense, you end up at operating profit. This is a key metric. And you see in 2024, we probably end up with about 9 billion, which is actually a 3% decrease over 2023, where I don't show the decimals here, but it was slightly higher. It shows here 9 billion on the slide as well. And keep in mind, in 2022 we were already at 14 billion, and compared to so my 2025 forecast results in 17 billion, which is only 3 billion more than where we were in 2022. And we know, I mean, what happened, margin compression, etc. We don't need to repeat all of this right now. And then we have crazy growth in 2026, like 38 billion. But again, this is not a forecast. This is an output from all the stuff we discussed before. And it's just the effects of multiple revenues line are scaling or coming online, all adding a little bit of gross profit, while the operating expense is growing not very much, because Tesla is just a very lean and mean machine, and that then just creates what's called negative jaws. We basically, revenue takes off, the negative expense stays kind of flattish, and this then creates like an explosion in earnings generation. And this is what this slide shows you. And then if we zoom over here, you can see there are more items. There's interest income, there's interest expense, other expense or income, and you get to profit before tax, and you then take off the income tax. Then you get to total net income, and the final item you have to remove before you calculate EPS is non-controlling interest. All these items, except for tax, are quite minor items, and that's why I don't cover them, but they're also all fully modeled out and flow through the model, just so you know, because otherwise this call would be way too long.
Earnings is going to explode in 26. So if you believe the assumptions we just saw here, the actual numbers, earnings specifically, will explode in 26. But 25, it's still a story. But boy, this is quick, how quick that jumps if all the assumptions are correct.
But also, I don't want to dismiss 2025. It's like what you just saw. If this is remotely close to what's going to happen, we could see almost doubling in operating profit, and this will do major
still
damage.
Significant enough, even 25. Okay, wow.
Wow. So that's why I'm so bullish. I'm telling you.
Wow. Okay. Well, so let's get to the stock price. You gonna get there?
Okay. Yeah. So now we got to shareholders' net income. So we jump from operating profit right to shareholders' net income, and then we wrap it up. And so we see here, and I want you to focus on this number. So everything you saw ends up in 11.7 billion in net income end of 2026. This 11 point.
Yeah, that's one quarter.
Yes, this is one quarter. Very good point. And then this 11.7. Hold this in your mind. We jump to the next slide. It's this number up here in green. That's the total earnings number. This number right here is the share count. This is also modeled out for share-based compensation, etc. And you divide this number by that number, and you get to the EPS. Yeah. And now, next step, look at this, 9.64. Hold this number. This is the sum of these four EPSs.
Quarters.
Keep the 9.64 in mind. We jump to this slide. This is the 9.64. This is the next 12 months EPS. Here we are back to the slide from the beginning. And now keep holding. I hope your short-term memory can do it. I'm just joking. Keep the 9.64. And now we jump to this slide. This is the 9.64. This is the NTM index for the future.
That's how you get 700.
Exactly. Nailed it. And you apply the 74, boom, gives you $713. So now everybody listening, up to you, whether you say this makes sense, it's rubbish, too conservative, too bullish. You have now all the information. That's basically all.
So you're predicting $600, the price of $600 by year end 2025.
Yes, exactly. And the reason, because technically, it's between 578 and 713. But of course, this is not in a staggered fashion like this. I explained here in the last bullet why it must be a staggered line. In reality, is of course it's a smoother line, and it's going to jump up and down towards those areas. And of course, there's some uncertainty, but look, a lot must go wrong to not cross the 500 line. And if, Tesla, as they have done often before, pull some rabbit out of the hat, we could end up even above it. And Elon, Doge, POTUS, this all creates, crazy scenario, frankly.
Okay, so what's your prediction for what's going to happen to the stock? Basically early 2025. When do we cross all-time highs of 412 or whatever it was? Based on earnings.
Okay, no, it's not going to be earnings. I think it will be in late January, and my rationale is a different one. My rationale is for the fourth quarter earnings call is typically where we receive guidance from Tesla. This year in January, Tesla's share price crashed after that call because Tesla didn't give us guidance. It turned out this was the right move, but Tesla traded down quite a bit because of that. But this time I know it's going to be different. And the reason why I know, or I'm very confident, is because Elon has already given us guidance. Last earnings call, Elon said, and this was a key nugget, he told us he expects 20 to 30% vehicle growth next year. For this reason, I'm totally sure next quarter, and he's extremely intelligent. He knows it's not good for his stock if he shuts up. So he knows he will give us. He will want to give us some guidance. He already did. Hence, this is basically in the bag. And when Elon comes out with this guidance, and of course, Tesla team will be super bullish on FSD, and now we have the videos to prove it, basically, and everything. The next gen vehicle launch is only probably few months away. Late January. I could talk about this for another 10 minutes, but there's so much coming together end of January. There's also a lot of AI momentum always in January, because January kicks off with CES, and CES this year will be all about AI, and NVIDIA will probably see great momentum. So there's a lot of stuff coming together, and then of course Trump inauguration is just a few days prior to the earnings call. Man, it's crazy. So I'm quite sure we see the 400 mark around that time. Anyways, as I could go on for hours, but I know we are running out of time. So, but this is basically my high level sort of summary.
Wow, AJ, thank you very much. That was unbelievable. That's a lot of work that you put in. You covered 13 revenue streams, but you actually have the every little line item. You've included every little thing, even the tiny little things.
Yeah.
But the assumptions felt to me was, I got to go back. I got to review, because obviously they're tiny numbers. So I got to go back but I didn't feel like anything popped out. I brought it up. The only one would be $2.6 billion in one quarter for robots. That was the only one that I'm a big believer in robots. You know that. So I actually agree with that, but that's the only one that is like a more of the bigger assumption that That's a bigger leap.
Yeah.
But
So
you actually were super conservative on Robotaxi.
yeah.
And then, and a lot of this was still, like you said, the auto business. And that I liked everything you said there. There was nothing there that I thought was a stretch. So
It will be a very interesting year for sure.
yeah, I think the point was that it's convergence, everything. There's so many line items now.
Yes.
And so each one of them kind of like adds.
Yes,
like,
exactly right. So sorry to interrupt you, but the big picture is really there's so much stuff coming together. You have to model it through and add it all up to see the big picture, and that's why I think you
that's
have
how
to
the numbers get big. Yeah.
Yeah, because it gets to when you look at my forecast, it looks quite wild. But then when you really deep down into it, you see, oh my, this makes really sense. It's actually that the wild thing about my forecast is that it makes sense. It's easy to slap $1,000 price target onto Tesla and call it a day. But no, I show you bottom up. There is nothing crazy in this forecast at all, really.
I love it.
Yeah, anyway, so that's why for a couple of weeks ago, I wrote to my subscribers and said, look guys, this is the real deal. I hadn't been this bullish about Tesla since 3Q, 4Q 2019, I said.
I'd love you to take away, like the bears will say, Robotaxi's not coming, the bot's not coming. So if you take this away from 2026, what do we get, you think?
It's I could work out the numbers precisely relatively quickly, like within this framework, of course. But the bottom line is about this forecast. 2025 is not driven by
any of those two,
not robotaxis. You see that the ramp curves, the timelines. I'm assuming it's all very backloaded. The big story, as I said earlier, is really about energy storage, because the Shanghai launching cannot be underestimated, because it's more profitable than auto. So as every dollar in energy storage revenue goes a lot further than every dollar in auto sales. It's just the reality of the margins right now, and so this makes it so interesting and so quickly growing.
Okay. AJ, thank you very much. Hopefully you'll do another show with us. This is the most comprehensive analysis we've ever done. I'd love you and CERN to get together one day. Boy, that would just killer combination between the two of you. Thank you, AJ. Follow him on his X account at ALOJOH at Alojo. And he also has a subscription. You can subscribe to him and you get this. I mean, it's worth it, right? It's like you're actually paying for actual value. You're getting analysis and information that you don't get elsewhere. So thank you so much, AJ. Appreciate this.
Thanks for having me.
That was wonderful. Appreciate you. Every investor needs to watch this. See you soon. Bye-bye.
See you soon. Take care. Bye-bye.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.